Held-to-maturity accounting exists for one reason: to let a bank hold a bond without recording the daily swing in its price, on the promise that the bond will be kept until it matures and repaid at face value. The rule assumes the bank will never need to sell early. Silicon Valley Bank held its bonds to maturity until March of 2023, when it needed to sell them. Between March of 2020 and March of 2021, the bank's deposits nearly doubled, rising from $62 billion to $124 billion, driven by venture capital flowing into technology and life sciences companies during the pandemic. The bank invested much of that money in long-term treasury and mortgage-backed securities, chasing a higher yield than short-term instruments offered. By March of 2022, roughly 46% of the bank's total assets sat in a held-to-maturity book of long-dated bonds. The securities portfolio as a share of total assets rose from 39% in 2020 to 57% in 2022, compared with an average of 13% among California banks and 20% nationally. More than 85% of that portfolio carried maturities beyond 5 years. Then interest rates moved. Between March and December of 2022, the Federal Reserve raised its benchmark rate from near zero to 4.5%, responding to the sharpest inflation surge in 4 decades. Bond prices move opposite to rates, and long-dated bonds move furthest. The market value of the portfolio fell through 2022. Under held-to-maturity accounting, none of that decline appeared on the income statement. The bonds were booked at what the bank paid for them, not what they were worth. The bank's governance thinned at the same moment the exposure grew. Laura Izurieta stepped down as Chief Risk Officer on April 29, 2022, moving into a transition role before leaving that October. Her successor, Kim Olson, was not announced until January 4th of 2023, roughly 9 weeks before the bank failed. For 8 months, while unrealized losses on the bond portfolio were compounding fastest, the position sat without a permanent holder. In August of 2022, examiners found the risk management program deficient and issued 3 supervisory findings. By the time of the failure, 31 supervisory findings sat unaddressed, roughly triple the average for a bank of its size. Held-to-maturity accounting was the first mechanism. 2 more sat beneath it. The first concerned capital. Under the Federal Reserve's supervisory framework for a bank of this size, a Category 4 institution was permitted to exclude accumulated other comprehensive income, the running tally of unrealized gains and losses on its available-for-sale securities, from its regulatory capital calculation. Silicon Valley Bank elected that exclusion. The Federal Reserve's own review of the failure later put the adjustment at $1.9 billion. Capital that appeared solid on paper because a separate, smaller pool of securities that was marked to market simply did not count toward the ratio regulators used to judge the bank well capitalized. The choice was legal. It was also, by design, invisible to anyone reading the capital ratio alone. The second concerned hedging. As of September 30, 2021, the bank held $11.3 billion in notional interest rate swaps, protecting part of its available-for-sale securities against the rate risk that was building. By June 30, 2022, that notional had fallen to $5.9 billion. By September 30, 2022, with the Federal Reserve still raising rates, it stood at zero. The bank had terminated its remaining hedges, booking $313 million in gains from the unwind to be recognized as income over roughly 7 years. Academic analysis of the decision found it extended the bank's overall asset duration from 3.7 years to 5.6 years, meaning the portfolio grew more sensitive to rate moves at the precise moment rates were still climbing. None of these 3 decisions was, on its own, a crime. Held-to-maturity accounting is standard practice. The capital election was permitted under the rules as tailored for banks of that size. Terminating a hedge is an ordinary Treasury decision. What the record shows is 3 decisions, made independently, that each removed a signal an outside observer might have used to see the exposure building, and that in combination left the bank's public financial statements describing a stronger institution than its own bond portfolio marked at actual market prices would have shown. By early March of 2023, the bank needed cash. Deposits had fallen by roughly $25 billion, or 13%, across the final 3 quarters of 2022, as venture funding slowed and technology clients drew down their accounts. To cover the gap, the bank had borrowed $15 billion from the Federal Home Loan Bank of San Francisco by year-end 2022 versus nothing a year earlier, pledging collateral worth about 3 times what it borrowed. On March 8, 2023, Silicon Valley Bank Financial Group announced 2 things at once. It had sold substantially all of its available-for-sale securities, realizing a $1.8 billion loss, and it planned to raise $2 billion in new capital to cover it. The sale was the tell. A bank does not realize a loss on securities it intends to hold. It realizes a loss on securities it needs to turn into cash. That same day, Silvergate Bank, a smaller lender to the cryptocurrency industry, announced it was shutting down, an unrelated failure that nonetheless primed depositors to watch for the next one. On March 9th, Founders Fund, the venture firm co-founded by Peter Thiel, advised its portfolio companies to move money out of Silicon Valley Bank, telling them there was no downside to doing so. Word moved through venture capital group chats and social media within hours. By the close of business that day, customers had requested $42 billion in withdrawals, not all of which the bank could settle. It ended the day with a negative cash balance of $958 million. Federal Reserve Vice Chair Michael Barr later testified that $100 billion more was queued to leave the following day, a 2-day total of $142 billion, 81% of the bank's deposits. On March 10, 2023, California's Department of Financial Protection and Innovation closed Silicon Valley Bank and appointed the Federal Deposit Insurance Corporation as receiver. 2 days later, Signature Bank in New York was closed by state regulators. That evening, the Treasury Secretary, the Federal Reserve Chair, and the FDIC Chairman issued a joint statement guaranteeing that depositors at both banks would have access to all of their money the following Monday. On March 27, 2023, First Citizens Bank shares purchased roughly $72 billion of the failed bank's assets at a discount of $16.5 billion. It did not take on most of the $90 billion in Treasury securities still sitting on the books. The same bonds whose falling value had triggered the collapse remained behind, a problem for the receivership rather than the acquirer. The Federal Deposit Insurance Corporation later estimated the failures of Silicon Valley Bank and Signature Bank would cost its deposit insurance fund $22.5 billion. The Federal Reserve's own review, published April 28, 2023, found that supervisors had identified the bank's problems but had not escalated them with sufficient speed. Some witnesses before Congress argued the review reached the wrong diagnosis, contending supervisors had focused on the wrong risks entirely. Analysts at the Bank Policy Institute later argued that even counting the unrealized losses, the bank would likely have still registered as well capitalized under the ratio, and that the missing signal was the disclosure itself, not the number. Both explanations rest on the same underlying fact. The accounting treatment of the bond portfolio kept the loss off the primary financial statements until the bank's own liquidity needs forced a sale, and by then the loss was realized, not merely unrealized. 2 civil actions followed. In January of 2024, an investor lawsuit alleged that classifying more than $90 billion of holdings as held to maturity had locked in risk rather than managed it. In January of 2025, the Federal Deposit Insurance Corporation sued 17 former officers and directors, including former Chief Executive Greg Becker, alleging negligence and breach of fiduciary duty. Becker had sold $3.6 million in shares on February 27, 2023, under a trading plan filed a month earlier. He later testified to Congress that he believed he held no material non-public information at the time. No criminal charge has been confirmed against him. The civil suit remains unresolved. In February and March of 2026, Senators Elizabeth Warren and Maxine Waters pressed Federal Reserve Vice Chair for Supervision, Michelle Bowman, over an external review of the failure and over the removal of some bank examiners, giving the Federal Reserve until March 24th of that year to respond. The accounting choice that hid the loss is no longer disputed. It sits in the bank's own filings and in the Federal Reserve's own review. What remains open is who should have caught it first and what it will cost them to answer that question in public.